Hello, everyone, and welcome to another episode of Inspired Investing. My name is Christopher Cox. I'm your host, and I'm joined by my co-host, Nicholas Marcano. And in this episode, we're going to be discussing taxes and how it pertains to your investments. So it can be one of the most important expenses you pay when investing. So it's important to keep tabs on what your tax liability is.
So taxes is a very important topic when investing. You pay taxes on every capital gain that is realized when you sell. So when you buy a stock and that stock grows in value, if you were to sell that stock for a profit, a taxable event is triggered. So you are required to pay taxes on that increase in value. In our last video, we discussed short-term investing. We described that short-term investing refers to any investment activity that occurs within a year's time. In the US, there are several federal income tax brackets ranging from 10% to 37%. You're taxed using a progressive system, which simply entails persons earning higher income are subject to higher taxes. It's important to understand that if you buy and sell stocks within a year's time, you are generally going to be taxed at the tax bracket that you fall into based on your level of income. Short-term taxes are generally higher than long-term taxes, so it's not necessarily the most favorable if you would like to maximize your returns on your investment portfolio.
Since we talked about short-term capital gains, we'll jump into the long-term capital gains, which is any investment that's held longer than a year. And these will be taxed at 0, 15, or 20%. And that is all based on your individual tax rate. And this will be more favorable typically to folks who have long-term investments and don't want to be subject to a high tax rate. Always consider that you will have a tax liability at the end, and it's all about calculating how much tax liability you have.
As investors, it's important to be as tax efficient as possible. You want to ensure that you're carefully accounting for the expenses as it relates to your investment actions and your investment activity. So next, we're going to be moving on to our Habits for Success segment. In this week's episode, we're going to be discussing Robert Kiyosaki. Most of you guys may know him as the founder of the Rich Dad Company. He's the author of 26 books, and the most notable one being the Rich Dad, Poor Dad series. He urges individuals to develop their financial literacy by engaging in financial education. He continues to state that honing your understanding of how money works as early as possible is essential so you can understand and identify ways to have money work for you. In his book, Rich Dad, Poor Dad, he also urges people to think of debt differently. He advocates for seeing debt as your number one asset. He emphasizes that debt can be classified as an asset only if invested into productive assets. So you have to ensure that the assets you invest in are productive. They are able to generate consistent income and cash flows to not only pay the cost of that debt, but also put that extra income in your pocket.
So we're going to be moving on to our Trending Globally section, where we talk about things that are impacting the world today. One of the most important topics right now in the world is the U.S. Debt, which is growing at a rapid pace in 2020 and is going to continue growing into 2021. But what does this mean for us? The modern monetary theory is that U.S. is spending, but disregarding the amount at the moment so that we can repay it sometime in the future. So that means more than likely taxes is going to increase in the future so that we can pay that down. The reason the U.S. can spend all this money is because they have U.S. taxpayers, U.S. corporations that they're relying on. So why is this important? Is because you can structure your investments so that they are tax friendly in the future. For example, Roth IRAs and Roth 401ks, you're taxed at the money you put in today. But in the future, when tax rates may be high, you will not pay taxes on those withdrawals.
It's important to be aware of your economic environment and develop a policy that seeks to protect your investment by making decisions based on the economic environment.
All right, guys, that does it for episode 3 of Inspired Investing. I wish you all best of luck.
Thanks for watching.